Hello, Assalamualaikum warahmatullahi wabarakatuh. So in this video, we are going to present to you about the liquidity ratio, the efficiency ratio, the profitability ratio and the leverage ratio of Supermax Corporation Berhad. Supermax Corporation Berhad is a leading global manufacturer and marketer of medical equipment of high quality, including medical gloves and contact lenses. Established in 1987 and headquartered at Sungai Buloh, Malaysia, the founder founded a trade business to sell latex gloves and subsequently went on to manufacture latex gloves in 1989. Today, the Supermax Group has 12 factories producing natural latex and natural rubber gloves of different kinds, which are exported to more than 165 countries around the world. The company offers products such as powder-free latex, test gloves, latex surgical gloves, free powder, test gloves, and so on. It caters to among other labs, clinic, pharmacy, physicians, and surgeons. After carrying out comprehensive R&D activity in the UK, it successfully commissioned its production facility in Malaysia in 2016 and is steadily building up its production potential. Moreover, the group has received numerous awards over the years, including the H Billion Ringgit Malaysia Company of the Year Award in 2010 and Export Excellent and Brand Excellent in the Industry Excellent Award in 2009 and 2008.
Well, hello. My name is Nabil Fidaus Miskam. So, what is the financial statement analysis? The financial statement analysis can be defined as a technique used to evaluate the strengths and weaknesses of a company. It is for the purpose of creating a better decision-making standard in improving the company value, and there are a few metrics that can be used to evaluate the financial statement, such as the liquidity, profitability, efficiency, leverage, and market ratio. And all of these ratios constitute a different type of role and a different type of interpretation. So, we move on to the first matrix, which is the liquidity ratio. Liquidity ratios are one of the major components in the financial statement analysis. It is used to measure the capacity on the part of the debtors to pay its obligation. Hence, the liquidity ratio will help Supermax in measuring their capacity to settle up the short-term obligation without raising any external financing sources. The term liquidity in the context of finance can be derived as the duration taken by the company to turn the asset into the form of cash. Firstly, the current ratio. This type of ratio focus on the ability of Supermax to pay their current liabilities for the year with the liquid asset such as the cash, inventories or trade receivable. The formula established is current ratio equal with current asset divided by current liabilities. As what we can see on the right side of the slides, the year 2020 shows a better result compared to the previous year, with the ratio of 1.27 and 1.06 respectively. The company now is able to use 1 ringgit and 27 cents of its current asset to pay 1 ringgit of its current liability. Next, the quick ratio, or also known as acid test ratio. The ratio indicates the company capacity to pay all current obligation, but by only use the most liquid asset in the company, which also means that the asset that easily to be converted to cash. Hence, the calculation will exclude the inventory because of the nature of inventory, which takes a longer period of time to be converted into cash. And based on the computation, we can see that the year 2020 has a greater performance compared to 2019, with the ratio of 1.1 and 0.75 respectively. Once again, similar like current ratio, where the higher the ratio will indicate a better performance. The Supermax is able to use 1 ringgit and 10 cents from its quick asset to settle up 1 ringgit of its current liabilities. Lastly, the cash ratio. It only focuses on the cash and cash equivalent in the corporation to pay all the current obligations for the year, and it reflects to the formula where the uses of current assets is narrowed down to only cash divided with all current liabilities. Based on the both year, which is 2020 and 2019, the ratio is 0.79 and 0.29 respectively. For the year 2020, Supermax is able to use 79 cents out of their cash to pay 1 ringgit of its current obligation. Hence, it can be said that the Supermax Corporation has a higher capacity to pay the short-term obligation with the use of cash compared to the previous year. Well, for the overall result in the liquidity ratio, it can be useful for the creditor to measure the capacity of company in settling up its loan. Hence, based on every ratio under this metric, Supermax has a good financial health and far from the issue of liquidity crisis due to the ratio show a better performance other than majority of the ratio shows a greater value than 1, which indicate the company has safety margin.
Assalamualaikum warahmatullahi wabarakatuh. Thank you Nabil Fidaus for the good presentation about liquidity ratio. I will continue the presentation by discussing about profitability ratio for Supermax Corporation Berhad. Profitability ratio are the class of financial metrics used to measure the ability of a company to produce profit compared to its sales, operating expenses, balance sheet asset, or sales or shareholder equity over time using statistics from a single point of time. Investor and borrower may use profitability ratio to determine the return on investment of a Supermax depending on the relative amount of a capital and asset. There are several calculations under profitability ratio. First ratio is gross profit margin. Is used by statistic analysts to determine the financial stability of a business by measuring the volume of money left over from commodity purchases following subtraction of the cost of goods sold (COGS) as stipulated in this slide. Those are the calculation for the gross profit margin available for Supermax for the year 2020 and the prior year 2019. Based on the calculation, it can be described that the gross profit margin for the Supermax in the year 2020 show drastic increment than in year 2019, which is 52.91% and 33.50% respectively. Every ringgit that Supermax generate in sales, a gross profit of 52 cents was generated for the year 2020. A gross profit of 33 cents was generated before other business expenses were charged for the year 2019. For the year 2020, sales for the Supermax have been increasing about 38% for the first half of the 2020 due to the increased demand for the medical glove to combat the COVID-19 pandemic crisis. Second ratio is operating profit margin, that profit of the organization earned from its operating. It shows the financial viability of the core company activity until any extraneous financial or tax-related consequence. As stipulated in the slide, those are the calculation for the operating profit margin available for Supermax in the year 2020 and the prior year 2019. Based on the calculation, it can be described that the operating profit margin for the Supermax in the year 2020 show an improvement than in the year 2019, which is 32.70% and 12.49% respectively. Every ringgit that Supermax generate in sales, operating profit of 32 cents was generated for the year 2020 and operating profit of 12 cents was generated for the year 2019. Means here that the Supermax has a better control for their operating costs than a year before. Third ratio is the net profit margin, that proportional to the amount of the net gain or profit generated as a percentage of sales. Net profit margin is the ratio of the net profit to sales for corporation or industry unit. As stipulated in the slide, those are the calculation for the net profit margin available for the Supermax for the year 2020 and the prior year 2019. Based on the calculation, it can be shown that net profit margin for Supermax in the year 2020 show an improvement than in the year 2019, which is 25% and 8% respectively. For every ringgit that Supermax generated in sales, a net profit of 25 cents was generated for the year 2020, and the net profit for the 8 cents was generated for the year 2019. This can be described in the 2020 Supermax as efficient management and having strong pricing strategies. And from the shareholder perspective, they have seen the potential of Supermax. Ratio is return on asset ROA is a measure on how profitable a business is due to its total asset. Return on asset provide the employer, customer, or analyze and understanding on how effective management of business is to use its property to earn income. As stipulated in the slide, those are the calculation for the return on asset available for Supermax for the year 2020 and the prior year 2019. Based on the calculation, it can be shown that the return on asset for the Supermax in the year 2020 show an improvement than in the year 2019, which is 60% and 6% respectively. For every ringgit on asset that Supermax invested in, it returned 60 cents in net profit for the year 2020 and 6 cents in net profit for the year 2019. The increasing about 10% in the return of the asset due to the effectiveness of the Supermax in using their asset to generate profit from it. Last ratio is the return on equity ROE, that a calculation of the financial success measured by measuring the net profit by the equity of the owner. Return on equity also can be described as the calculation of the rate of return on the expenditure of a common shareholder on or net worth. As stipulated in the slide, those are the calculation for the return on equity available for the Supermax for the year 2020 and the prior year 2019. Based on the calculation, it can be described that the return on the equity for Supermax in the year 2020 show an increment than in the 2019, which is 34% and 10% respectively. Basically, for every ringgit of equity that Supermax invests in, it's returned 34 cents in the net profit for the year 2020 and 10 cents in the net profit for the year 2019. A higher return on equity means that Supermax is more effective when it comes using the investment funding to expand its business. Increased return on equity means that a company is growing its production of income without the needs too much money, and it also show how effectively shareholder money is deployed by the company's management. In the nutshell, the overall result in the profitability ratio can be useful for an investor to put their investment in Supermax due to the excellent performance than previous year. Based on the every ratio under this matrix can simplify that Supermax has a good financial health due to the increase in each ratio from the usual indicator, and put the Supermax as the main attention for the investor to invest their fund due to the high return of investment.
So, Assalamualaikum warahmatullahi wabarakatuh. My name is Afif Bin Ismail. Okay, let's continue to efficiency ratio. The efficiency ratio is usually used to assess how effectively a business uses its assets and liabilities internally. This ratio can also be used to monitor and assess the efficiency of commercial and investment bank. In other words, efficiency ratio calculates the capacity of an organization to leverage its assets and liabilities to produce revenue. The efficiency ratio tests the potential of an organization to use its properties to produce sales. For example, the efficiency ratio also looks at different areas of a business, such as the time it takes to obtain cash from consumer or the period of time it takes to turn inventory to cash. This makes efficiency ratio significant, since improving efficiency ratio typically results in improved profitability. Firstly, the calculation need to do under efficiency ratio is inventory turnover. The inventory turnover ratio tests the ability of a company to handle its inventory effectively and offer insight into the company revenue. The ratio calculates how many times the overall average inventory has been consumed over a period of time. The inventory turnover ratio is calculated by dividing the cost of goods sold by the average inventory. So in 2020, the cost of goods sold is 1,022,085,583 divided by its inventory, which is 253 billion 236 million 36,000 and 656. So the result, after we calculate, the result is 4.0361 times. Compared to 2019, the cost of goods sold is 1,024,840 and 503,000 divided by its inventory 181,940 and 317. So after divided, the result is 5.6328 times. So based on the computation, the results show that the inventory turnover ratio in 2019, which is 5.6328 times, is higher than in 2020, which is 4.0361 times. Thus, the higher the inventory turnover ratio, it will be better for the company. It shows how many times the company turn over their inventory into sales. Therefore, the company is doing better in 2019 for their efficiency in turning their inventory into sales. So other than that, the calculation continue to calculate the average collection period. The average collection period is the amount of days between the day on which the selling of the credit is made and the date on which the customer pay the payment. The average collection period of a company is representative of efficiency of the accounting activities of its account receivable. The average collection period is determined by dividing the average balance of account receivable by the total net revenue for the period and multiplying the quotation by the number of days in the year. So in 2020, the account receivable is 341,066,831 divided by its sales 2,131,807,991 and multiplying by 365 days. So we get 58 days in 2020 compared to 2019. The account receivable is 173,808,070 divided by its sales 153,156,739 and multiplying by 365 days. So we get 41 days. Based on the calculation, show that in 2019, the average collection period is faster or quicker, which is 41 days, than in 2020, which is 58 days. So the faster or the shorter the number of the day, it will be better because it indicates the number of days to collect the money or profit. Therefore, it shows that the company in 2019 is doing better in efficiency of collecting procedures. the company able to collect, meaning that the company able to collect debt faster than they did in 2020. Besides that, the next element under the efficiency ratio is total asset revenue turnover. The asset turnover ratio test is the capacity of a business to successfully produce income from its asset. In other words, the asset turnover ratio measures revenue as a proportion of the asset of the company. The ratio is useful in showing how much sales are produced for every dollar of asset owned by a corporation. The ratio of total asset turnover is calculated by dividing a company's revenue by its total asset. So in 2020, the sales is 2131,807,991 divided by its total asset, which is 3204,390,447. So we get 0.6653 times. Compare in 2019, sales 1538,156,739 divided by total asset 1842,707,680, and we get 0.8347 times. So based on the calculation, it shows that the total asset turnover in 2019 is higher, which is 0.8347 times, than in 2020, which is 0.6653 times. So the total asset turnover defines how much the company uses the total asset in generating sales. The higher the turnover, it will be better for the company. Therefore, the company in 2019 doing better in terms of their total asset turnover. It shows the efficiency of the company in using the total asset in generating the sales and the revenue. Next, the calculation need to do under efficiency ratio is receivable turnover. The turnover ratio of receivable defines how well a business can actively recover its debt and expand its credits. In other words, it calculates how many times a company can transform its account receivable into cash over a period of time. The ratio of receivable turnover is determined by dividing the net profit of the company by its average account receivable. So in 2020, the credit sales or sales is 2131007,991 divided by its account receivable, which is 341,066,831. So we get 6.2504 times. Compare in 2019, credit sales or sale is 1538,156,739 divided by account receivable, which is 173,080,070, and we get 8.8497 times. So based on the calculation, the receivable turnover ratio of the company in 2019 is higher, which is 8.8497 times, than in 2020, which is 6.250 times. The ratio shows how many times the company can transform its account receivable into cash over a period of time. So the higher the ratio, it will be better for the company. Therefore, the company is doing better in 2019 because the company is able to transform more of the account receivable into cash compared than in 2020. Last but not least is the fixed asset turnover. Fixed asset turnover determines how efficiently a business manages its fixed asset to produce sales. The higher the ratio of fixed asset turnover, the more successful the company investment in fixed asset has been. In comparison, the higher ratio means the business pay less money on capital asset for any cash or of sales income. At the same time, a decreasing ratio means that the organization has over-invested in fixed asset. So the calculation of fixed asset turnover is by the revenue of the company divided by fixed assets. So in 2020, the sales is 2131,807,991 divided by fixed asset 1,290,666,280. So we get 1.6517 times. Compare in 2019, sales is 1,538,156,739 divided by fixed asset 1,206,995,858. So we get 1.2744 times. So based on the computation, it shows that the fixed asset turnover ratio in 2020 is higher, which is 1.6517 times than in 2019, which is 1.2744 times. The fixed asset turnover ratio defines how much the company uses the fixed asset in generating sales. The higher the turnover, it will be better for the company. Therefore, the company in 2020 is doing better in terms of their fixed asset turnover. It shows how much the efficiency of the company in using the fixed asset or non-current asset in generating the sales and the revenue. So in the consequences, the efficiency ratio in 2019 show a better result than in 2020. Thus, it shows in 2019, the company is better in the capacity of an organization to leverage its asset and abilities to produce the revenue or sales.
Assalamualaikum. Hi, my name is Farhan bin Fadhil. Okay, lastly, we will move to the leverage ratio. The leverage ratio is an overview of how company is managed and whether the company is willing to cover its interest expenditure. The leverage ratio is consists of debt ratio, debt to equity ratio, and also the time interest earned ratio. First is debt ratio. Debt ratio is the percentage of the asset of the company that are financed by debt. It can be calculated by dividing the total debt with the total asset. The debt ratio is increasing from 38.45% in 2019 to 51.61% in 2020, which means the liabilities of the company are increasing compared to the asset of the company. It indicates a higher level of liability compared with the assets which are considered highly leveraged and more risky for lender. In other words, the company would have to sell off all of its assets in order to pay off the liabilities. Second is the debt to equity ratio. It is measure the ability of shareholders' equity to cover all the outstanding debts in the event of the business downturn. It can be calculated by dividing the total debt with the total equity. The debt to equity for the year 2020 is 106.66% and 62.46% for the year 2019. A higher debt to equity ratio is risky because it shows the investor have not funded the operation as much as creditor have. This could mean the investor don't have to fund the business operation because the company is not performing well. And lastly is time interest earned ratio. It is evaluate the capability of the corporation to consistently repay its debt obligation. It can be calculated by dividing the earning before interest and tax with the interest expense. It shows the Supermax income is 40.8294 times greater than the annual interest expense, which are in 2019. The income is 9.7418 times greater than the annual interest. This means the performance of the Supermax in 2018 is increasing and able to cover the interest expenses in the future.
So we have come to the conclusion part. In a nutshell, the result in the liquidity ratio can be useful for the creditor to measure the capacity of Supermax in settling out its loan or debt. While for profitability ratio, it can be useful for investor to evaluate the company whether they should invest in the company or not. Since the company shows excellent performance for both years, most of the investors are attracted to make investment in the company. Besides, the efficiency ratio in 2019 shows a better result than in 2020. In 2019, the company is much better in the capacity to leverage its asset and liability to produce revenue. Moreover, the leverage ratio of Supermax showed a bad performance in 2020. It showed that Supermax has more liability compared to their assets. And because of that, the company necessary to take initiative to way to reduce their liability in order to create a good reputation to the investor. In addition, the computation of each ratio in every year is crucial in order to evaluate the company, whether the company is doing well or not, especially in terms of their performance. The management of the company may develop new strategy if the company is unable to achieve their target performance due to the several factors. For example, the outbreak of pandemic COVID-19 occurred in 2020, and due to that the company has to bear more liability in 2020 in order to cover up their expenses.